Good morning and welcome to the ParkBridge Wealth Management Winter Webinar Series. This program is entitled Highlights of the 2026 Heckerling Institute on Estate Planning. As always, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not for profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning, and you can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, The Wall Street Journal, and Trust and Estates Magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money. And you can listen to that on Apple, Spotify, or wherever you get your podcast. One last item. I recently published my first book, D is for Diversification, the ABCs of Personal Finance, which can now be purchased on Amazon or at jonathanonmoney.com. Today, we're privileged to hear from Kevin Matz, a partner at ArentFox Schiff based in New York City. Kevin is a leading advisor to high net worth clients on domestic and international estate and tax planning, estate administration, and related litigation. A trusted counselor to families and family offices, he combines deep technical expertise with practical judgment. His work spans wealth transfer planning, drafting wills, trusts, gifts, estate income, and GST tax planning, charitable giving, probate, and complex valuations. Kevin also guides clients on sophisticated strategies such as family limited partnerships, GRATs or revocable trusts, CUPRITs, ILITs, and charitable remainder and lead trusts, as well as private foundations. A nationally recognized speaker, Kevin presents at major conferences on leverage transfer techniques and planning for private equity professionals, real estate investors, athletes, and artists. He's also a national authority on qualified opportunity zone funds and has testified before the U.S. Treasury on proposed regulations. Today, Kevin will be speaking on highlights of the 2026 Heckerling Institute on Estate Planning. And with that introduction, I'll now turn the program over to Kevin.
Well, thank you so much, Jonathan. Hello, everyone. So it's funny you mentioned the winter series. At least here in New York, the last couple days have topped 70. I think it was 78 the other day. So I think we're now going to be into the series. But be that as it may, we're going to talk today for the next hour about the recently concluded, or now 2 months ago, Heckerling Institute on Estate Planning down in Orlando, Florida. And I'm going to talk initially at a high level, the main themes, so that this way everyone will have a roadmap as to what was covered. And then in the materials, you'll have a lot more. I'm going to then drill down on various items just to emphasize them, make sure that all the points, again, are covered. Happy to field questions afterwards. I don't know if we'll have time, but between now and 9:30 to field questions. I understand we won't. But this is to provide, a taste of what happened at Heckerling, and the most important items and ideas that were expressed and exchanged among professionals. Now, before I jump into what was covered, just a word about the Heckerling Institute on Estate Planning. It is basically the place to be in January of each year. Number one, for those of you who are in up north, like me, in the New York City area. So it's down in Orlando, Florida, but that's not the only reason. And again, it's down in Orlando, Florida during January. But it's a week-long conference that's devoted to wealth management industry issues, developments, uh, key legal and tax developments in conjunction with that. It's also a tremendous opportunity to network. So again, it's a week-long conference held at the Orlando World Marriott. There's some other affiliated hotels too that could very easy to either walk to, order shuttle to, with constant shuttle buses throughout the week. But to give you a sense of scope, the total attendance this past year topped 4,400. And yes, there's also a virtual option, but the total in-person attendance was over 3,200. So think of that. 3,200 trusted estate wealth management professionals, attorneys, CPAs, financial planners, insurance professionals, family office professionals, all there for the better part of a week. in close surroundings. It is at a scale unlike any other. If you haven't been there, strongly commended. I've been going each year, with the exception of the COVID years, were solely virtual, but each year since 2005. And going back to about, I think it was 2010, 2011, I started doing highlights of Heckerling, in part for my own knowledge, to make sure that I reinforced what I took away and learned at the conference. And when you part of the best way to ensure that you learn something is to be able to summarize it and then explain it to others. So that was about 15, 16 years down the road for it. I've spoken a couple times at Heckerling too. Just a great, great conference, and I'm happy to share this with each of you today. So, what were the key themes with that preface? You know, you aim for a top 10 list. I recently through my firm put together an article about the top 10 legal challenges facing family offices, high net worth individuals and families as well here in 2026. For Hackerling, with some of the other items discussed, I figured I can't exactly do 10 without doing justice to some of the other themes. So here I have a top 14. So just to go through it to make sure that everyone has exposure to what was covered, and then we're going to drill down. So, a lot of time spent on the new tax law, the One Big Beautiful Bill Act. Correct name of it we'll talk about shortly is actually HR 1 because it was part of the budget reconciliation process. The One Big Beautiful Bill Act was as a name was technically stripped out of it as being quote unquote extraneous, but quite often it's referred to that in that manner, quite often referred to as OBBA or OBA. And also in Washington, I understand, actually speaking with folks from the IRS national office there, quite often they refer to it as OB3, which for those of you remember Star Wars, kind of like has a Star Wars type connotation there, Obi-Wan Kenobi. So, but OB3. So if you hear me saying OBA or OB3, that's what I'm referring to. Very important aspect, especially in wealth management. We now have permanent, permanent exemptions. The sky is no longer falling on a sunset to half the levels that we had in potentially in 2025. We now have permanent provisions in effect, $15 million. Talk about that shortly. Effective as of January 1, 2026. Bear in mind that, and although this wasn't covered too much in detail at Heckerling, bear in mind if you live in a state such as New York, which is my home state, quite often you have to be concerned about state estate taxes, or states such as New Jersey, state inheritance taxes. So just because we're dealing with $15 million of exemption doesn't mean you don't have to plan from an estate tax standpoint. You do if you happen, number one, if you happen to be above that, factor in portability. Also, you have to make certain elections for generous could be transfer tax or GST tax purposes, but always bear in mind your home state. New York only has a $7,350,000 exemption. Here in the year 2026, it has this very, in lack of a better word, nasty feature of its tax law called the New York Estate Tax Cliff that says we're going to give you a credit corresponding to that. If you're slightly above that, we're going to take it away on a hyper accelerated basis. So that if you're 5% above that, a little over 7.7 million, you're going to be taxed from dollar one. And that actually produces in lack of a better word, confiscatory marginal tax rate in some cases of over 200%. Um, more on that perhaps another day, but that's something to bear in mind. Always got to consider state death taxes too. Another item addressed: Trump accounts, Section 529 plan expansion. Next, big theme at Heckerling this year, both in terms of substantive law developments and also in terms of practical challenges in representing clients and ethical considerations. Marital planning, including marital trust planning. What if you have a Q-tip marital trust that's been set up? Um, you get the estate tax marital deduction. One spouse dies. But what if there's a desire of the surviving spouse, together perhaps with children, to get together do more planning? You got to watch out for this section in the Internal Revenue Code called specifically Section 2519, which provides that if there is a deemed disposition of an income interest, the entire remainder, whatever that is, it could be a small amount, it could be $100 million, is a deemed gift that's made. Now, there have been various cases over the past 18 months, 2 years that have addressed this. The Annenberg McDougal case in particular. What about if the children give up their remainder interest? Are they deemed to be making a gift, the surviving spouse? We'll talk about that shortly. That got a lot of attention. But then the whole issue of marital trust planning and some of the ethical issues in representing both spouses. That got a tremendous amount of attention, in part sparked from a New York, not a trust and estates case, not a tax case, but rather a family court case, or rather a family law, matrimonial law case, CS versus RH. CS versus RH. And yes, the initials abbreviations are used to protect the innocent here. That got a lot of attention. What happens if marital assets are used for the planning and everything's going well until they're not in this particular case because there's a divorce? And what happens if the estate planner has represented both spouses, and then the one spouse, in this particular case, the wife, says, "I thought this was just a tax shelter. I didn't realize that I would no longer have access to these assets here, including by virtue of being able to have access through rental agreements or otherwise." Do these assets get considered for marital estate purposes, marital asset purposes, in the event of divorce? The answer in CS versus RH, we'll talk about that, got a tremendous amount of attention in the Heckerling, is yes, at least in New York, they do count under the particular facts that are set forth. And as we'll talk about, the facts are rather extreme there, but it is a very cautionary note. Along those lines, terrific programs, collaborative estate planning advisory team, navigating issues pertaining to attorney-client privilege. Let's say it's not just attorneys working with CPAs, other wealth management professionals, financial planners, trust companies. What do they speak about? Speak to each other with the client there. Do you potentially lose attorney-client privilege? What are the best practices to preserve attorney-client privilege, to preserve confidentiality, and when do you maybe have to set up dividing lines? That got a lot of attention too. So some of the discussion was, well, in some cases, depending on the sensitivity of the discussion, if there's confidential information being conveyed to an attorney for purposes of advice, so as to invoke the attorney-client privilege, in that case, maybe the other professionals in the team need to step out from the meeting, be it in person or be it via Zoom or Teams or other virtual platform. Maybe you need to have a so-called Coval agreement that addresses it, which says that that other professional quite often works with the accountant, CPA, is basically serving as an agent to assist the attorney to, in some ways, effectively translate difficult financial facts so the attorney can render fulsome and comprehensive advice to the client. That could work, but you have to be very mindful because otherwise there's a risk of loss of attorney-client privilege. Terrific program, special needs planning. Tara Ann Pleat presented on that. She's the current chair of the Trust and Estates Law Section, New York State Bar Association. So just some eye-opening facts concerning how, basically, as a practical matter, family members serve as a safety net, and that's not really recognized um, quite often by the government also in terms of economic analysis that's related to it. But if you are doing special needs planning and you have a beneficiary who stands to inherit, watch out, because that could be considered a resource that could disqualify that beneficiary who has disabilities, who has special needs, from eligibility for government resources. Splitting, splicing, and stacking strategies to add octane to trust structures. Wonderful presentation. Diana Zadel, Jonathan Blattbacher, my partner, Todd Agatovich talked about sophisticated estate planning techniques. We'll cover some of that in context, including the LCAN case. We'll talk about that shortly. There was some discussion too about cases maybe about 18 months ago now. Estate of Fields case. You got to watch out whenever you're planning with family limited partnerships. Simply the ability to participate in liquidation decisions as a limited partner, to join together, reiterates a holding of the state of Powell case, which was a 2017 tax court case. That is an estate tax triggered under Section 2036A2, which means unless you're able to override that by virtue of the bona fide sale exception, to the application of Section 2036 of the Family Limited Partnership or Family Limited Liability Company posture could result in a state tax inclusion of all the assets without any discounts, lack control, lack of marketability, unless one say, well, nothing ventured, nothing gained. You got to try, right? Well, not necessarily, So as I've written about going back a number of years, if you're trying to have a reduced to zero marital trust planning formula, you actually can frustrate that because you cannot have phantom assets passed to a marital reduction trust that could actually accelerate estate tax to the first spouse's death. In addition, what you had in Fields is that you had the IRS say, "Come on, we think that you should have you the executor should have known of Section 2036 or consulted counsel as to that. And are you thinking that you could make $6.5 million disappear by transfers to an FLP about a month before the decedent died? That was likely too good to be true. No reasonable cause exception. We're going to whack you with a 20% accuracy related penalty, and the tax court upheld that. So you could actually be worse off than doing nothing with FOP planning. So watch out. Huffman case, again, that's really more 2024, but just a note there that you got to watch out for another technical provisions, so Remedy Code Section 2703. Whenever you have interfamily agreements, they can buy-sell agreements. We had the Connolly case from the year before, Supreme Court case. Hoffman involved an option agreement to basically buy about $31 million worth of company stock for $5 million pursuant to the option. It was an interfamily agreement. The court evaluated, do you running the gauntlet of the potential exceptions under Section 2703B in the Internal Revenue Code? It was not met on an evidentiary matter as being able to show that the agreement was comparable to other agreements between parties who are unrelated at arm's length, and therefore, instead of having a $5 million valuation for the closely held business interest pursuant to the option agreement. Instead, it was at fair market value with the option agreement disregarded. That was at 31.3 million. Ouch, a big tax hit to the taxpayer there. Turning it around though, a favorable tax court result. The estate of Barbara Galley case versus commissioner. There, it says that if you do things right with a promissory note and you have a loan and you dot the T's I'm sorry, you cross the T's and you dot the I's, and you have a promissory note that actually is rendered. You pay interest in the promissory note according to its terms. You actually have the payments reflected in bank records. The interest is at the AFR, which might have been actually slightly below market, but was still at the safe harbor of the applicable federal rate. In effect, even with a balloon note with interest payments, they were timely made before mom died. That was held to be respected by the court. Why? Because they did it right. They crossed the T's and dotted the I's. So that's something that is not so much a cautionary tale, but it is something to point to as to if you do it correctly, you follow the terms of the loan, you have interest paid timely, you have a reasonably well drafted promissory note, you have an AFR interest rate, that will be respected as a loan. And the IRS has tried to say, well, you know, decedent died here. There was an argument that was made in connection with the estate tax return that there should be a discount applied to the promissory note from 2.3 million down to about 1.6 million because interest rates went up compared to the AFR. And the IRS attempted to argue that therefore this should be treated as a gift and not a loan, but the tax court would not tolerate that. It said everything was done right here. There may have been a change in interest rates over the course of time, but the taxpayer and the both parties respected the terms of the loan. They honored it, and therefore we, the court, are going to respect it as debt, as a loan, and will not give any credence to the IRS's argument that instead should be treated as a gift. A case that got a lot of attention. Item 12 here, the LCAN case. And this is a case, there's no reported decision right now. It is an ongoing litigation. The taxpayer just filed their reply brief on this last week. This involves a grantor retained annuity trust. We'll talk about this shortly, but basically about or multiple grantor retained annuity trusts that were funded to the tune of about $1.5 billion, not million, but billion with a B. And there were swaps in exercising the power substitution, which is a grad or trust trigger that was built into the grad. It was a very well drawn grad, and by virtue of the swaps in were actually with a promissory note of the grantor. It then came time for the annuity payment to be made by the grad trustee to the grantor. Got to pay out what you have. So what did the grant trustee pay? Paid the grantor's promissory note that was swapped in. The IRS said that that's too clever. We think that you've actually blown the terms of a grat, so don't have a qualified interest in a grat, and you think you had a $1.5 billion transfer, getting back a roughly $1.5 billion annuity. Think again. We think that you have a non-qualified interest. You're going to have a $1.5 billion gift, and there was actually this gift split between spouses. So, so the spouse who did not make the gift, she got tagged with about with over $300 million right there. And on top of that, they said, again, being asserted quite heavily by the IRS these days, we're going to tack onto that a 20% accuracy related penalty for negligence and disregard of the rules. So again, that is right now being litigated. The primary argument by the taxpayer is that if you look at the regulations, which are the regulations that the IRS is bound by, it does not prohibit the return of the grantor's own promissory note to the grantor. What it says, it prohibits financing arrangements and prohibits the grant trustee from issuing its own promissory note, not returning the grantor's promissory note, but issuing its own promissory note to fund the annuity amount. Essentially, the IRS that's taxpayers' argument. The IRS is saying that, you know what, by doing it this way, you effectively had a de facto commutation, which is prohibited under the regulations. Taxpayers' further argument is the regulations don't accord with the statute, and therefore, under the Loper-Bright Supreme Court case 2024, is not a best reading of the 2702B statute, and therefore should be disregarded. So stay tuned. That is currently in litigation. Couple other items that are addressed here. Qualified small business stock. There was a terrific presentation by Paul Lee on that at Heckerling, Section 1202. Section 1202 has been around since 1993, but it really got hypercharged when the corporate rate, because you need to have domestic C corporations involved here, when the corporate tax rate got lowered to 21% in the Tax Cuts and Jobs Act of 2017. Here with OB3, we now have a situation that there's a further enhancement in the benefits of the qualified small business stock. Basically, it says that if you meet certain criteria for a domestic corporation, that's a C corporation, and you have stock that's been issued not through a secondary market or subsequent sale, unless it's a gift that's truly not a sale, or someone's inherited by death. But if you have issued stock directly from the issuer, or someone to step into shoes of the transferee of the issued stock, you're going to have a situation where that person can exclude substantial capital gains, and the amount of capital gains that could be excluded are the greater of a per taxpayer limitation, which had been 10 million, is now up to 15 million, or if greater than that, 10 times the basis. And you could have stock here that used to be limitations of $50 million. It's now raised to 75 million. You could potentially have qualified small business stock, QSBS, for assets for stock with a total basis is up to $750 million. And then there's techniques to further enhance that, stacking techniques that could be utilized via gifts, including to non-grantor trusts that are set for taxpayers. So that has been probably one of the greatest areas that I've been contacted about and called about here in 2026, and that got a great deal of attention at Heckerling. The other item that I've been getting a lot of calls on here in 2026 It was touched on a little bit at the very end by Clary Red in his wrap-up program at Heckerling, but it is something that is very critical for those of our clients who have invested in qualified opportunity zone funds going back to the last several years is that subject. Item 14, qualified opportunity zone funds. We now have a tranche two for qualified opportunity zone funds that kicks in as of January 1, 2027. Uh, Very importantly, tranche one under the Tax Cuts and Jobs Act ends on December 31, 2026. And the whole notion here is to basically to spur investment in economically distressed communities defined as qualified opportunity zone, qualified opportunity zones or OZs. um, Congress decided we're going to allow this new vehicle statute to be created, qualified opportunity zone funds, which could then be funded with capital gains. It has to just be capital gains that are then within 6 months of the capital gain occurring or deemed to occur. There's certain elections that could be made that my materials address. You can defer the gain potentially to an outside date of December 31, 2026, possibly with a 5-year hold or 7-year hold, make up to 10% or 15% respectively of that gain disappear, and then also be able to, with a 10-year hold, have any subsequent appreciation avoid tax whatsoever. The key item that I mentioned here, in addition to the tranche two, which extends the rules and changes some of the rules, is the date of December 31, 2026. Today is March 12th, 2026. So that is less than 10 months away now. And that is when all the deferred capital gains become due, less the basis adjustments. One thing I will note, and I've written quite a bit about this, that under the terms of the final regulations that came out in 2020 from U.S. Department of Treasury and the IRS, there's actually a lower of rule, and this is also in the statute too, a lower of rule that applies. It's the lower of the deferred gain on December 31, 2026, or the fair market value of the qualified opportunity zone fund interest as of that date, which means that if the values have gone down over the course of time, with benefit of an appraisal, the amount of the tax could be potentially substantially reduced. One thing I would note, and this was made clear by the final regulations that came out in 2020, back when I spoke as part of a panel in Heckerling in 2020, I actually confirmed this with a government official who was involved with drafting it, because it seemed to be the import of the language. Is a fraction built in. Question I get a lot of quite often is, do you get any discounts, lack control, lack of marketability associated with that? And the clear answer, at least by virtue of the fraction that's in the regulations, that was confirmed to me by a Treasury official who was involved in drafting it, is no such discount will be available. Whoops, actually just hit my computer. I'm still here though. That's what happens when I raise my hand. But let's drill down on some various items, okay, during the next half hour or so, 32 minutes. So again, formal title. Yeah, it's referred to as the One Big Beautiful Bill Act, OBA, OBBBA, or OB3. But if you want to get technical, by virtue of the budget reconciliation process and with the name being stripped out as quote unquote extraneous, it is instead, the formal title is HR 1, an act to provide for reconciliation pursuant to Title 2 of H. Con. Res. 14. So just so you know, what are the various items addressed by OB3? I've already touched on some of these items, but just to drill down a little bit. So we now have a quote unquote permanent $15 million estate gift to generators could be transfer tax exemption beginning here in 2026. That is going to be indexed from year to year. What I mean by permanent, you no longer have an expiration date. Under the Tax Cuts and Jobs Act, you had a situation where the quote unquote temporary doubled exemption was scheduled to sunset to half that level after December 31, 2025. By virtue of OB3, the expiration date got removed, and then we had a further bump up from what otherwise would have been 14.4 million. Half of that would be only 7.2 to now 15 million. What that means is we no longer find ourselves in the posture of, for those clients who are above the exemption levels, of use it or lose it. under the regulations that had come out a number of years ago, final regulations, Treasury and the IRS made clear that if you made gifts, used up your exemption, there wouldn't be any clawback so long as you don't have a situation that was considered abusive or a string provision. Think Section 2036 apply. And therefore, much of planning involved. Planning was, especially for married couples, spousal lifetime access trusts, SLATs. So this way, people would make gifts still through a spouse, have quote unquote backdoor access, so at least the spouse could enjoy the benefits, but lock in the exemption, which would otherwise be lost if there were to be a reversion to half that level due to the expiration after December 31, 2025. No longer have to worry about that. You could basically take that from one corner of your brain and say, I don't have to worry about that anything else except as a historical footnote. We now have a permanent exemption. Now, what does permanent mean? Permanent means, well, there's no expiration date anymore in the statute. It is possible it could be changed, of course, by a subsequent Congress. I don't think anything's going to happen over the course of the next 3 years, but you just never know down the road. So that's something to bear in mind. But at least there is no longer an expiration date. It is no the mantra of use it or lose it, which was so pronounced at least prior to the November election 2024, is no longer applicable. Some of the other changes brought about by OB3, we now have a $40,000 assault deductions, state and local taxes. Subject to phase out, though, once you get above $500,000 of the applicable threshold amount, that's increased from $10,000. After that phase out, it gets back to $10,000. Importantly, the pass-through entity tax credit is preserved. People say, well, what's so news about that? That actually was not so clear that result would follow. Earlier versions of OB3 actually called for an elimination of the pass-through entity tax credit, but that was left on the chopping, I guess the chopping floor, as they say, and didn't make its way to the final bill. Section 199A pass-through deduction for qualified business income. Not so much. There wasn't a technical change there, but the phase out, the limits where you get subject to phase out were increased significantly under OB3. So that's something to bear in mind too. Something we'll talk about shortly. Trump accounts in Section 529 plan enhancements. Trump accounts have now come in. We actually just had proposed regulations that came out concerning the pilot program. Discuss that shortly. One item that got a fair amount of attention at Heckerling, and is also through American College of Trust and States Council, ACTEC has got a great deal of attention as well, is we now have a permanent suspension of miscellaneous itemized deductions. So they aren't just suspended as being deductible, they are just non-deductible. But then on top of that, if you have itemized deductions, there is now a limitation of 237ths. And what do I mean by that? And 237ths, why not 240ths or 250ths or something like that, or 2/100ths? Well, think in terms of the top tax rates that apply. Top tax rate, putting aside the net investment income tax or self-employment tax, top tax rate ordinary income is 37%. What Congress has said that even though the top tax rate is 37%, if you have an itemized deduction, the maximum deduction benefit you're going to get from it is going to be capped at 35%. And therefore, 37 minus 35 is 2. 2 divided by 37, that's how you get 2/37. Now, how does this affect the world of many of the folks who are listening to this webinar series today? Well, it affects the way the statute appears. It's not so clear what the result is concerning the distribution deductions for trusts and estates, and then also the Section 642C deductions for distributions from trusts and estates to charities. There is a fair argument to be had just by reading the statute that those deductions are itemized deductions. And because they're itemized deductions, and because there was an elimination regarding the distribution deductions for trusts and estates, from being itemized deductions and subject to limitations under Section 68E, which was repealed, the concern is, and based upon language in the Senate Finance Committee report, there is concern that deductions for distributions, effectively allocations to beneficiaries from trusts and estates, are subject to this floor. There's also concern, notwithstanding the language of 642C that talks about it being without limitation, there is a fair reading that charitable deductions for what gross income distributed out from trusts and estates, charitable beneficiaries are themselves subject to this limitation. Now, what does that mean? That means, like, let's say, and this applies whenever you're in the top tax bracket. Now, here in the year 2026, you hit the top tax bracket for trusts and estates at a very low level. It's the case in prior years where it's now at $16,000, not 500 or 600,000, but $16,000. So everything above that's a 37% bracket. So let's say you're $1 million above that, and let's say you're distributing out to beneficiaries. You'll have $370,000 and then $1 million above that once you get into the 37% rate of tax. However, the trusted estate will only get, if this in fact is the case, and again, there's a fair reading that's the case, although I will tell you that clarification has been sought by some organizations, including American College Trust and Estates Council, as to this, with some very good arguments as to why this should not be happening, but at least we requesting clarification both from Congress and then also from Treasury/IRS, that if you have a $370,000 of income, you only get a tax benefit deduction of $350,000. So a trust or estate, which think of in terms of the nature of the conduit taxation, the purpose here is you tax either the trust or estate, or by virtue of the mechanism the distributed distribution deduction for DNI, distributed net income, that's distributed out to beneficiaries, or you tax the beneficiary. You're not supposed to tax both. It's one or the other. However, if you have $370,000 of tax benefits at the as trust or estate level, but you only get a $350,000 deduction for it, you effectively have double taxation, even though the whole purpose of subchapter J in the Internal Revenue Code is to avoid double taxation. Does that make sense? It doesn't make much sense, but that seems to be the implication of the written word by Congress. So I can tell you organizations, including American College Trust Estates Council, I believe also the AICPA is now submitted on this, have said, hold on a second. Did you really intend this, Congress, to do this? Maybe this warrants a technical correction, at least to clarify. And then what about with charities? Well, it's even a worse case scenario with charities because charities are designed to not pay any tax. However, you're even though you could the goal for the trust or estate based upon the language of the trust instrument or the will could be to zero out, nevertheless you're subject to potential taxation here on income that is ultimately going to charity. Does that make policy sense, ladies and gentlemen? I submit it doesn't. ACTEC submits it doesn't. AICPA agrees as well. But stay tuned. At this will be hopefully we'll get favorable corrective action, either by Congress or by Treasury or IRS over the course of time, um, addressing this. Other items addressed, the charitable deductions, you now have different rules for itemizers and non-itemizers. There's now a 0.5% floor for itemizers, non-itemizers, even without itemized deductions, you now get a potential married filing jointly $2,000 charitable deduction. So that's changed. Note here on excise taxes on colleges, universities under the new tax law, not on private foundations. No change there. And a couple items I've already mentioned. Uh, Qualified small business stock expansion. I talked about that, and also we have this new tranche rule for qualified opportunity zone funds. Again, regarding federal, state gift, and GST tax provisions, we now have permanence, but permanence really means not subject to a sunset or expiration that's hardwired into the law. Uh, what this means is a practical matter, though. The exemption level is so high that doesn't mean that clients don't have to worry about tax planning, aside from dispositions being exactly where they want it to be when they're no longer living. You got to think in terms of income tax planning. And sometimes if you're not worried about estate taxes, including state estate taxes, sometimes you're going to want a state tax inclusion. Why? because if you have a state tax inclusion, you get a step up in basis to fair market value, which could wipe out any built-in capital gains tax that applies. Or for depreciable asset, things in terms of real estate could basically restart the clock at a much, much higher level on when you could depreciate assets. So income tax planning are become even further heightened in importance because of this. I talked about New York State. Jump over to Trump accounts. Now, Trump accounts are new creatures of statute under a new Section 530 Cap A of the law. It allows for aggregate contributions for up to $5,000 each year. It's going to be indexed for inflation. That's eligible to be made by parents, relatives, taxable entities, nonprofits, and governmental entities. This is only for persons who are under the age 18. Under the age of 18. If you're over 18, you could contribute to a Trump account, but you cannot be a beneficiary of it. And the notion here is basically a built-in savings account where there cannot be any distributions made before age 18. These would be managed by banks or institutions and would generally have to be invested in stock index funds or other diversified investments. In addition, there were just proposed regulations that came out last week on this from Treasury and the IRS. There's also a one-time governmental credit of $1,000 that will be provided to certain individuals born in the years 2025 through 2028 who are U.S. citizens. So, what issues are presented in the trust and estates world? Well, we have a contribution that's being made to an account that cannot be accessed by the account beneficiary until they attain age 18. Um, is that a present interest in property? Well, doesn't meet the definition of the present interest in property because it's not accessible until someone who's under 18 down the road turns 18. Now, very interestingly, with Section 529, not 538, but 529 plans, think in terms of college tuition and related cost plans that are set up by the various states under a federal enabling statute. That addressed it actually under a technical provision under Section 529 that hits this head on and states that for purposes of Chapter 12 Internal Revenue Code dealing with gifts and Chapter 13 dealing with the generous gift transfer tax, any contribution into a 529 plan shall, per the statute, it's actually 529C2A1 of the Section 529 statute, any contribution will be deemed to be a completed gift to property that is a present interest in property, not a future interest, and therefore qualify for the gift tax annual exclusion. Unfortunately, that language was not present in the enacting statute for Trump accounts. So I can tell you, American College Trust and Estates Council has had two separate letters, that's gone to Congress addressing this, also to Treasury and the IRS. I consider the Treasury and the IRS has taken the position we'd love to help you, but this is something that Congress has to deal with because you look at 529, they had a statutory language that affected that. It would be we don't have that here, so hopefully that there will be the corrective fix at some point. Trump accounts are scheduled to go live on July 1. So hopefully we'll have a corrective action taken by Congress to clarify the contributions to it once we hit July 1 will in fact qualify for the gift tax annual exclusion. What happens if they don't? It means that if someone makes, say, a $100 contribution to a Trump account, technically they have to file a gift tax return to report that. And if it's to someone who's two generations down, think in terms of a grandchild, or if unrelated, more than 37 and a half years younger, you then have to also report that as a generous skipping as a skip for generous skipping transfer tax purposes. And if someone has used up all their lifetime exemption for gift or GST tax purposes, they will actually have to pay gift tax at the rate of 40% on that. That can't be what Congress intended. Unfortunately, the language seems to provide for that, but hopefully that will be corrected before we go live on Trump accounts on July 1. 529 plans, there's discussed in Heckerling, there's been an expansion of it. That basically is broadened. An item that I can tell you the AICPA was very much involved with the advocacy on concerns qualified post-secondary credentialing expenses that are added to include tax-exempt distributions that go to fund CPE credit for CPAs, or CLE credit for attorneys, or CE credit for financial planners. You can now have that set up. But the one thing, cautionary note, even though that's allowed, and you're not going to have a non-qualified distribution that is subject to income tax and subject potentially to an excise tax at the federal level, what look at your state rules. Look at your state rules, because not every state plan automatically conforms to federal. And you, if you were to say, let's have a distribution here that under OB3 works, you may be subject to state income tax by virtue of that. So you have to watch out. Watch out. Again, a major theme discussed: marital trust planning. You had a troika of cases: the Annenberg case. You had also the McDougal case, and then beyond that, you had the Griffin case. Um, for the first two of the cases I mentioned, Annenberg, McDougal, we're dealing with a saga of a qualified terminable interest marital deduction trust, which again is a trust that has to that for which an election is made on the estate tax return. Could also be set up via gifts, by the way, but in this context, it was in context of the estate. The property, basically, the surviving spouse has to have a qualifying income interest for life, meaning the right to all the income, and no person can have the power to appoint any of the property to anyone other than the surviving spouse. Okay, so what's the issue there? Well, the issue there is what the surviving spouse expects to live for a very long time, and those are the assets that are best suited, in the view of the advisors of the surviving spouse and maybe the kids or further the remainder beneficiaries for down the road, for further estate planning. How do we proceed there? How do we access it? Well, if you have broad discretionary distribution authority given to the to maybe an independent trustee to make distributions besides income, besides health, education, maintenance support, but discretionary distributions out to the surviving spouse, that would be one way. But what if that's not conferred under the terms of the trust instrument? And also, what if perhaps the independent trustee maybe gets nervous about making distributions out to a surviving spouse, perhaps the remainder of what's in there, and says that I want to make sure that the kids don't sue me, so I'm going to want them to consent to this. Well, consequence here was, let's get the kids together with the surviving spouse and make the distributions. And the IRS had two separate arguments. First argument, asserted in both cases, Annenberg and McDougal, was, well, there should be a deemed gift by surviving spouse here, because there was further planning that was done down the road, that basically then, with surviving spouse, after the termination of the trust in the surviving spouse's favor, Annenberg was going to court. McDougal was a non-judicial settlement agreement without going to court. Further planning: is there a gift by the surviving spouse? And the tax court in both cases said, no, there's no gift by the surviving spouse. Surviving spouse, if anything, is making a gift to himself or herself. You can't make a gift to oneself. Therefore, no gift. But the second argument that was made by the service, by the IRS, wasn't made in the Annenberg case, but it was made in the McDougal case, was, okay, the kids had the right to remainder interest. And then there might be subsequent transactions in which they get benefits. But if we just freeze frame and you look at the termination where they have a remainder interest, and all day one and day two, they have nothing. There may be subsequent sales to intentionally defective grant or trust in their favor, maybe part of a plan, but you just freeze it at that point in time. Haven't the kids made a gift to the surviving spouse? And that wasn't raised in the Annenberg case, but it was raised in McDougal. And McDougal, the court said, yes, there was, in fact, we do, in fact, regard there to have been a gift by the children holding the remainder interest when they consented to the termination of the Q-tip trust in favor of the surviving spouse. So then the $100 million question, literally, because that's what the IRS is asserting, is, okay, there's a gift by the kids. What's its value? The IRS is saying, well, it's a $100 million trust. We think it's about $100 million a gift. Pay up $40 million of gift tax. Taxpayer was of the view, well, hold on a second. They're how do you know that these kids are going to survive? They're surviving in this particular case, their father. That why are you assuming that it's such a high value? It could well be that over the course of time, everything gets spent, or would have been spent in the Q-tip trust prior to the termination. So maybe it should be some value, but a speculative value that's discounted very heavily and much lower number. So that is right now, presently being litigated in the tax court. And important theme discussed at Heckerling was, the IRS is getting much more assertive in these contexts, especially when it comes to the question of consenting to a transfer. You had an IRS litigation position from the national office and Chief Counsel Advice 2023-52018, where they said if you consent to a gift, or consent to a transfer, you're potentially deemed as making a gift right then and there. And then it's a question to be litigated as to how much is involved. So this is an area that the IRS has been increasingly focused on. One point in the Griffin case illustrates that if you don't make a Q-tip election, don't have the requirements for Q-tip trust, all income paid annually to surviving spouse, and no one could be a beneficiary of the trust other than surviving spouse. And very importantly, wasn't done in the Griffin case. You have to make the Q-tip election on the estate tax return, or if it happens to be an inter vivos gift on the gift tax return. That wasn't done here. Disqualification. But there was a potential saving grace in a smaller trust concerning a so-called estate marital deduction trust, where at the end of the day, everything got paid to the surviving spouse's estate, and that was held to be a saving grace. On this subject, spend a little bit more time because I've covered a number of items already. But there was the case CS versus RH, that happened, and this tied in with prominent themes of conflicts and joint representation. Some great discussions. Bruce Stone, Stephanie Loomis Price, Jim Doherty, Laura Wolven all spoke about issues pertaining to, let's say you establish a spousal lifetime access trust, a trust as to which one of the beneficiaries doesn't have to be exclusive current beneficiary, but one of the beneficiaries is a spouse, and everything seems to be going well. But there are two ways that marriages can end, right? They could end by virtue of death, a spouse dies. They could also end by virtue of divorce. And what happens if you created such a trust and it ends by virtue of divorce? And there were some very sobering figures that were stated by Bruce Stone in his presentation. 42% of first marriages end in divorce. 66% of second marriages end in divorce. Nearly three-quarters of third marriages end in divorce. So therefore, isn't it reasonable to think that there could be a conflict at some time during the course of a representation of both spouses? And therefore, isn't it reasonable to think that as estate planners, if we're representing both spouses, and maybe one spouse is a little bit more dominant, we have to make very clear that both spouses understand what's being communicated to them, maybe have sessions, just go over it by Zoom or in person, make sure they understand, and make sure we document it in writing. And that raises a whole bunch of questions, including under the ethical rules. What if, and Bruce Stone posits situations, what if one spouse says, "Don't tell my spouse, but I have a secret non-marital child," or there's someone else, a secret paramour, want to benefit. Don't tell my spouse. But what happens if you're representing both? And this is going to this is a pickle to be in. The answer to it's going to depend upon state law and also the terms of the engagement letter. But also what happens in planning, even aside from that, quite often for flexibility, it's desired to have a quote unquote floating spouse concept. A floating spouse concept is the spouse of what happens to be married to, grantor happens to be married to from time to time. Which, if you're only representing, say, grantor or say a husband, let's say a husband in this situation, maybe that's not a problem. But if you're representing both, you have to be very clear that this means that if after, if the wife were to die and the husband were to remarry, then that second spouse or third or fourth spouse, whatever it may be, could also be a beneficiary of the trust of the trust that's being set up. The spousal life and assets trust is being set up. Also, it means that if there were to be a divorce, then a subsequent spouse would step into the shoes of the divorced ex-spouse as a beneficiary. And that's something that if you're representing both spouses in estate planning, the importance of what was shared at Heckerling, and I fully agree with, is that has to be communicated to both spouses so they understand exactly what this floating spouse concept means. And we had a recent case that brought it to its head, and that's the New York lower court case of CS versus RH. And this got a tremendous amount of discussion um, throughout Heckerling and its implications. So here we had a situation in which a husband created an irrevocable grant or trust for the benefit of his daughter and also grandchildren, and marital property as defined for New York law purposes, was used to fund those trusts. So you had the husband in 2001 create those trusts for the benefit of the daughter and grandchildren, transfer marital assets to the trust. The husband, RH, had the ability to remove and replace the trustee. He could also swap assets via power substitution. Husband maintained the ability to manage the trust assets for investment purposes via LLCs that were owned by the trust. After the wife brought a divorce action, the husband, who had various investment authorities, including the LLC, basically cut her off from the assets, including certain marital homes that were transferred to the irrevocable trust, basically evicted her. And then mid-trial, he said, I want further protection. Let's decant these trusts to Delaware. Okay, and we'll get better protection from the courts. I can tell you the New York court did not appreciate that. And there was testimony at trial. The wife testified at trial that the husband assured her these trusts were set up as tax shelters, and she would forever have a role in these trusts, and their assets would be enjoyed by her. Don't worry, honey. You're going to continue to enjoy it. Just sign here. Now, the wife did not have her own separate counsel. She testified that she was informed by her estate planning lawyer, who represented both her and her husband, that she was not informed what would happen to the assets in the event of divorce. So the court looked at this. Again, we're not talking about a trust and estates matter in surrogates court or probate court. We're not talking about a tax matter, although this could potentially have tax implications. Think in terms of Section 2036 or 2038, stream provisions in Severity Code if the husband were to die. But the court said the value of the trust assets we're going to include in the marital estate for purposes of the equitable distribution to the wife, even though these trusts are valid trusts and were not a sham. And the court said, we're going to award the wife 50% of the value of the husband's holdings, including these trust assets, and we're going to establish a sequence. Sequence is the husband's non-trust assets are to satisfy the equitable distribution award first. And even though this will render the husband insolvent, we think that the husband will be sufficiently enterprising and will be able to figure out a way to borrow from the trust or otherwise receive distributions from those irrevocable trusts as to which he is not a beneficiary, to be able to satisfy the balance of the award to the spouse. Again, there were not enough marital assets available to pay the wife. So essentially, this rendered the husband insolvent. Now, again, lots of discussion to Heckerling. This was not a tax case, but question, what if the IRS were to say, aha, if the husband were to die here, you thought you had a irrevocable gift, but you were able to access these, enjoy these assets, including to provide, pursuant to the court order, to access these assets to satisfy your legal obligation of equitable distribution. Husband were to die, is in their inclusion under Section 2036, or probably more technically more correct, 2038 in the Revenue Code. And then question, how do you avoid this? Do you maybe have separate counsel in the estate planning for husband and wife? Again, reverting to that issue I stated. Or maybe you have independent trustees and independent LLC managers. Again, you had the husband as the investment manager. So that permeated throughout all the discussions at Heckerling. And I see my time is up. I think I've covered everything, at least to a little extent. But those were the key issues that were presented at Heckerling this past year. Again, if you haven't attended the conference, strongly suggest that you consider it next January. It is a place to be, a place to come together as a profession and as an industry. And I hope to see you there.
Great. Thank you so much, Kevin. And if anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Kevin or myself where appropriate. And I'll be sure to include his contact information in the follow-up email to the program, in addition to the slide deck, which I've already included in the reminder emails, but I'll send it out again tomorrow morning. Three more quick items before I let you go. First, my next webinar is on Tuesday, March 24th on Retirement 2.0 Modern Retirement Planning Strategies for 2026, featuring yours truly, Jonathan I. Shenkman, President and CIO of ParkBridge Wealth Management. And I'll be sure to send out the invitation to this program in the coming days. In the meantime, if you have a friend or colleague who would find these webinars of interest, they can subscribe to my webinar distribution list by going to parkbridgewealth.com/webinars. Second, you can follow all my work on X and Instagram at Jonathan on Money by connecting with me on LinkedIn. You could also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my practical planning videos, which I post several times a week, by follow me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.